Hello, everyone. This is Romain Danielou. Good morning, good afternoon for the ones that are already in Europe. I hope everyone is doing great. I'm super excited to be sharing our new portfolio today, portfolio 22. This is a parcel located 30 minutes away from San Antonio. I'm going to share my screen. We're going to get right into it. And we will take questions at the end. We're going to be here for the next 45 minutes. There's a lot of information I want to share with you on this very special deal. There's great returns that we are papering on this deal. Again, land is, to us, the best investment you can ever make. It has a limited supply. As long as the infrastructure is growing in the city and the demographic growth is growing, the land value is going up. And LandQuire helps you to do that as a private investor, accredited investor, to invest in our deals. So let me share my screen. Please let me know if you can see my screen in the chat. If someone can let me know in the chat to make sure that you can see the presentation. Okay, great. All right, let me share this. Let's get right into it. All right, perfect. So today I'm presenting a 94-acre parcel for which we're going to raise roughly $3.9 million of equity, right? This is including all the acquisition costs, closing costs, the land costs, and all the entitlement costs. I will go into the details, but this is the pool of money that we're raising. You're buying shares in the entity that will buy the land, and you become an investor by buying shares, equity, pref equity to be more specific, in that entity. The land is located in Cibolo, Texas. It's 30 minutes away from San Antonio, on the northeast of San Antonio, where we have a high growth corridor. We're right on the I-10, roughly 500 feet from the highway. And this is why we were interested in that deal specifically for the topography and the density that we could get. Here, after our analysis and pre-conceptual and conversations with the city and our land planners, we're looking at subdividing this parcel in 264 lots. These lots will be 70 by 140. 70 by 140, you get to 9,800 square feet, which is a little bit bigger than all the subdivisions comps that I will share down the line. We have a minimum investment of $100,000 only for accredited investors, and we're targeting to either sell that parcel fully entitled, shovel ready, to one of our developers that we're working with on ground at $32,000 a paper lot, worst case scenario, or we would actually do the construction in 3 phases of 88 lots per phase and sell these lots at $90,000 per lot. You will see that $90,000 per lot based on the comps is conservative because most of the comps that I will show to you is above $100,000. We're targeting a 19 to 24% IRR in a 2-year exit if we sell fully entitled and shovel ready. Again, the entitlements for our deals in Texas always take anywhere between 9 to 12 months. We have a 100% success rate for subdivision deal in Texas, and we do have over 2,000 lots that we already entitled in the Texas market. So LandQuire is very familiar with that state. If we decide to actually go and do the phase B because builders want us to actually build the infrastructure and sell them, finished lots, then you're looking at anywhere between 25 to 31% IRR, depending on your investment amount. So I'm going to go into the details of the financial model as well. For that presentation, we're going to talk about the market opportunity, the team behind the project overview, the financial overview, and we're going to do a deep dive in the data room. A little bit of structural fundamentals. As you may be aware, if you're living in the US, we do have a housing crisis. Freddie Mac is talking about a $2.3 million structural deficit of housing units. This has been lasting for the last 15 years. Post the financial crisis, a lot of the builders went bankrupt and basically were late on the amount of housing unit that we need in order to catch up, especially in Texas. I'm repeating myself because Texas today is the #1 demographic growth state in the entire United States. We're 20% ahead of Florida and 2.4x ahead of California. We're talking about 500,000 people that moved in Texas last year. Okay? Just to give you an idea, where do you want to invest in land? Well, where people will need housing, right? Builders are actively building, but a lot of builders are lacking their drug. They need land. And a lot of the land parcels out there are either not entitled or they're entitled, but not entitled the way they want. And again, a lot of the builders now prefer to pay a premium to get those land parcels entitled shovel ready before they actually put it on their balance sheet. Okay. Now, Texas, in terms of the GDP growth, we are the #1 state growth as well. And third, we are the #1 state in terms of infrastructure investment growth. This is a very important metric as a land investor. Is your city actually putting water lines, sewer lines, and electricity to give you what you need in order to build housing? And Texas is. This is probably one of the most pro-development states out there. The beauty about San Antonio and the surrounding areas is that it's still a city with cheap land. Here we're talking about buying that piece of land at $36,000 per acre. And I will show you that this is probably a 20 to 25% discount based on the $50,000 per acre on average land parcels that's sold in that specific market. Now, more specifically, to Cibolo. Cibolo is the zip code in which the parcel is located. Cibolo has had 163% population growth since 2010. Give me a city where you're investing where the population did 163% growth over the last 10 years. This is really important. This is really important because now the city is preparing for 50,000 people living in Cibolo by 2030. We're currently at 22,000 people. And this is why they are making a $285 million investment in the development of the I-35 expansion and I-10 expansion. Okay? So we put some of the links here for you to actually go check out the sources. San Antonio, again, is the 7th largest populated city in the US. Okay? But a lot of people are now buying cheaper land on the outskirt of San Antonio, similar to what happened in Houston, similar to what happened in Dallas, similar to what's happening in Austin. A lot of the people are priced out. So they actually are buying either finished lots outside of the city limits of San Antonio, or they're actually buying brand new homes from their preferred builders based on the median income. Again, these houses that are being built here are houses that are anywhere between $300,000 to $600,000. And again, they get 9,800 square feet on that piece of that on their lot, which is great. Imagine getting 9,800 square feet in Miami, how much you would pay for a finished lot. Here we're talking about $90,000. This is why the market is interesting for a lot of people and why they're moving to Texas, and more specifically in the northeast corridor of San Antonio. They're in between Austin and San Antonio. They have cheap land. They have brand new homes that can be built, and a lot of builders that give them great product. Okay. A little bit of key platform metrics for LandQuire. We are a team of 25 people full-time between acquisition, entitlement, disposition, data, finances, and investor relation. We started this firm with my partner Thibault in 2021. So far, we have 22 projects completed. 6 of them already sold, and the rest is currently under entitlement or under contract to be sold. We raised right around $40 million of equity from our investors. Above 400 investors already invested with us. The average realized IRR is 22%, and most of our deals sell anywhere between 24 to 36 months. So again, a little bit about us. Thibault has been living in the US for the last 15 years. He has had a property management company that he exited. He did over 600 fix and flip in the Floridian market, Texas market, and Ohio market. So he has a deep knowledge in the US real estate market as a licensed broker dealer and also as a former property manager, company owner. My background is more focused on operations, tech, and data. I focus on making sure that all the departments are talking together in order to move forward from sourcing a deal to all the way selling the deal to a final builder. Okay, so there's a lot of steps in between. You source the land, you run your due diligence, you make sure that you acquire the land properly with a clean title. Once you own the land, you make sure that the entitlements are on time and not over budget. Right? We work with LGA on ground, that is our preferred land planner, and we had a great relationship for the last 4 years with them. They're actually handle all our entitlements in Texas, and then on the disposition end, again, we need to make sure we have a proper marketing process with our preferred broker on ground that is selling our single-family residence subdivisions. His name is Greg. And he's the one that gave us the comps for that specific deal to support the disposition price. I will go into it right now. Some of the deals that we have as a track record in the data room, you have the full track record, but these are 3 examples. One is actually in Bowie, Texas, where we subdivided in 34 lots. The whole period was 900 days, and the annualized IRR on the deal was 36%. The second one was in Yuma, Arizona. We entitled it for a hotel. Today, the hotel is built and stabilized from the person that bought it from us. It was a hotel group. And on our end, as a land flip, we did a holding period of 626 days and an annualized IRR of roughly 30%. The last one was in Oregon. That's a market that would probably not go into anymore. They're not as pro-development as Texas. And that deal was shorter. It was only a year, and we realized the 13% IR. The executive summary about the deal we're talking about today. Okay, so like I said, we're buying 94 acres, great access, 500 feet from the highway. We have a minimum investment of $100,000. You're basically buying equity, preferred equity, in the SPV buying the deal. The preferred return is 10% per year, meaning that we're not getting paid until you make at least 10% per year. And on top of that, you make anywhere between 55 to 70% of the profit above your preferred return. Okay, so it's a very aggressive preferred return. This is really what we're targeting to be competitive in the capital markets and making sure that investors are happy. In terms of the exit, as all the single family residence deals that we have, there's 2 options. One, very similar to our portfolio 13, we acquired the land, and then shortly after acquiring the land, a national builder came along and offered us a great amount to put it on the contract. And so we were supposed to close in the next 60 days, and that would be a year and 8 months in terms of the amount of time that we held the parcel. So that's the option A, right? We're buying, we do the entitlement, and then we sell it at a discount for a builder that is willing to do the infrastructure. So here, if we do that, will go over the model. We're looking at roughly a 62% ROI on your money. We are underwriting this at a 2-year hold period, which would give us on the deal a 27% IR. I will go over the net IR for LPs in the financial model in a second. So this is obviously, we would just do basically the $3.89 million equity raise. There's a $1.7 million seller note that would be paid off. We reserve the interest for 3 years in the equity raise. So we wouldn't have to do any capital call. We just sell the land fully entitled, shovel ready for a builder. And that's kind of our short-term exit. If we don't get a builder interested in the paper lot value, then what we do is that we move into the phase B, which means that we do the infrastructure and the full development in phases, right? You don't want to go and do it until you have a contract in front of you from a builder that is willing to actually buy your lots as soon as they're built. If we do that, then we go out and we source a construction loan to do the first build out of the 88 first lots, right? You divide 264 by 3, you get 88. So we would do 3 phases. It could be 3 phases, it could be 2 phases, it could be 1 phases. I don't think it would be more than 3 phases. We've never seen that. But most of what I see right now from the builders and based on the feedback that I get from the developers and the broker is that we're anywhere between 2 to 3 phases on that amount of lots. Okay. This is a very typical subdivision size for regional or national builders. It's not too small, it's not too big. The last deal that we're selling on a paper lot basis on the west of San Antonio, we're looking at 1,000 lots, and they're buying the whole thing at the end of phase A. But again, we have some deals where we're gonna have to do the infrastructure because some of those smaller builders prefer to have finished lots. And this is what we want to plan out. As soon as we finish the entitlement after year 1, we would go out, get a construction loan, and build the first 88 lots, okay? And if we do that, once we've finalized the 3 phases, you're looking at a roughly 3x equity multiple. So you basically triple your investment. The IRR based on that $90,000 per lot would be 40%. And I will explain you now why $90,000 per lot is very reasonable. I added you 3 comps, recent comps that are actually under contract or sold by our broker, and that have very similar size of lots and very close location. Okay, so our portfolio is located here on the yellow map, on the yellow pin. And then here are the 3 comps that we found that are very recent. One is Chasing Heights, one is Judah Ranch, and one is Marion Oaks. Okay, so how to explain you how builders think. First of all, we're buying the land at $36,000 per acre, and here are 2 sites that we found very close to us that sold above $50,000 per acre. Okay, so those are similar size of acreage to do similar subdivision that have access to water, sewer, or wastewater plant treatment, and then access to electricity with a great access to main highways. Okay, so those are 2 great comps that we found to show you the basis of the price per acre we're getting on the raw land. Now on the finished lots, these are the 3 subdivisions that have sold or are under contract. And the way that the builders calculate is typically a number of dollar per front footage. Okay, so these 3 are anywhere between 1600 to 1700 feet per frontage. Okay, we are deciding to basically sell at roughly 1300 per front foot, which would be a pretty steep discount, which gives us the 90,000. So the way you calculate it is that you do your 70, which is the front foot. This is really what builders care about. Okay, most of the lots have a width of 70 and a length of 120 to 140. But what matters to a builder is really the front foot. Okay, so if you do 70 times what these guys sold, let's say on the low end 1600, this would mean that we would sell our lots at $112,000 per lot. I decided to be conservative and just put $90,000, okay, which gets you the $1,285 per front foot. Okay, so it's just to be conservative on the underwriting to make sure that if the market goes down, we still have roughly 1285 divided by 1600. We have a 20% buffer if the market goes down. Now, if the market goes up, then great. We sell at 1700, 1800 per front foot. Great. If it goes down, at least we have a 20% buffer in order to still achieve our 3x equity multiple. Okay. So like I said, our parcel have a direct I-10 access. We're on the main corridor connecting Cibolo to the AH-10, providing efficient access to major employment centers and enhancing appeal to regional home builders. Okay, we have electricity, we have the water, we have a 6-inch water line. The water study is still on the way, and we did a pre-application meeting with the city last week, which went great. So this is exactly what we like. We like to buy those kind of parcels that are flat with a great access, with builders around already buying, and with lots that give us the density of 264 lots for the 94 acres. Okay, so that's in terms of the pricing. Now, in terms of the projected timeline, you're looking at investing in June. We're looking to close this at the end of June. From there, for 12 months, we're going to have the full entitlement, right? So water study, traffic study, topo study, new survey. We're going to have the plans being submitted to the city, all the conversations back and forth in order to actually finish the subdivision on paper and get 264 lots approved, okay? From there, we either sell at the phase A or we decide to build the first 88 lots, okay? If we decide to build the first 88 lots, we would only do it if we have a builder that puts a contract in front of us giving us a 10% non-refundable deposit, which is very typical in that scenario. Okay. And like I said, the exit here is planned between 2029 to 2030 to fully recapitalize. Again, as soon as we sell the first 88 lots, we pay off some of the loan, construction loan amount. There will be some proceeds left, and we would start distributing capital back to investors. You make your capital first back, then you get your 10% per year, and then your profit share. In terms of the subscription, it's pretty easy. We've been improving our platform for the last 24 months. We have an internal investor platform for you to actually create an account, do the subscription, and from there either create an LLC if you decide to create an LLC. We do all the K1 tax reporting for you to do your tax reports. We help you open a bank account if you're offshore and you've never had a bank account in the US. So in terms of customer service, we have a turnkey solution for you to make sure that you can invest as a limited partner in a land deal. Okay, so you're buying shares either personally or with your holding company into the SPV, which is the entity that will own the land. LandQuire Management, which is the general partner, is the fiduciary responsible to make sure that we buy the land, we do the entitlement, and we sell the parcel either on a phase A or on a phase B, depending if we decide to do the construction of the infrastructure or not. Okay, like I said, 100% of distributions are allocated to the LPs until their initial capital contribution has been fully returned. Once you got your return of capital, you get your annual 10% preferred return. Okay, and then from there you get your profit sharing, anywhere between 55 to 70%, depending on the amount you invest. I will give you the details in a second. Okay, once you get there on the brochure and you receive the brochure in your email, feel free to click here to access the detailed financial model. Okay, and then you are at the end, you also have the full data room. Okay, so going into the financial model first. Please confirm me in the chat that you can see. I'm gonna put bigger. So it's a very detailed financial model. Like I said, 94 acre, 264 lots is the target density. We're looking at doing 3 phases if we do the phase B. The lot sale price assumption is $90,000 per lot. Like I said, based on current comps, we're looking at a value of $112,000 minimum, but we prefer to be conservative. We're looking at a 5% selling cost at the disposition, 3% for the broker, and then 1% for the title company, and 1% as a disposition fee income for the fiduciary, the general partner. If we decide to do the phase B, we're looking at a 12% loan interest rate, which is pretty conservative on this kind of deal as well, knowing that the lender would get 100% of the collateral if we default on it. The home builder contribution, if they want to buy us out at finished lot basis, they would have to put 10% down. Okay, we're looking at a target construction per lot cost at roughly $40,000. So you'll be able to find the breakdown directly in the phase B construction breakdown here. Okay, if we decide to do the build out, we're looking at a $13 million build out in phases. Okay, so I'll go into the phase in a second as well. It's just to give you the assumptions. The 10% preferred return, the project hold will vary. If we decide to sell on a phase A basis, typically it would be 24 months. If we decide to do the phase B with the construction of the infrastructure, we're looking at 48 months. Okay, 1.4 million. Okay, the great news is that our acquisition team was able to negotiate 50% deferred payment on the seller note after 3 years. Okay, so we pay 1.7 million right now, and we have 3 years to pay out the rest of the 1.7 million. We would have to pay the 1.7 million before we actually start the construction. Okay, so this is the details breakdown of the $3.896 million we're raising. Okay, so very transparent. You can see where exactly the money is going to go. That's very important. Then you have the different phases of the construction. So you'll see that the phase 1 is a little bit more expensive because we will have to install the wastewater plant treatment, which is basically the treatment of the water, which is replacing your traditional sewer. So here, you will be able as well to see all the details in order to build the first 88 lots for phase 1, phase 2 of the second 88 lots, and phase 3. And then you have the total, okay? So that's very important to understand. From there, you will have the phase financing and sales. This is trying to understand what is the net sales proceeds after we pay off the loan, the selling cost, and the loan interest, okay? Very important. From there, you have the project return summary. So on the project level, there's 2 options. You have the phase A, that is here, where we're looking at a equity multiple between 1.6 to 1.9, depending on whether we give a 20% discount to the builder, which would be great for them. But typically for the last deal for portfolio 13, for example, we gave them a 15% discount. And if we do the same thing here, we're looking selling on a phase A basis, we're looking at a 91% ROI on the deal, 38% IRR on the 2-year basis. And here is how much you would make as an investor depending on how much you invest. If you invest between $100,000 to $250,000, you're getting roughly 19% IRR. If you invest between $250,000 to $500,000, 20% IRR. If you invest between $500,000 to $1 million, you're looking at 22% IRR, and 24% would be for people investing above $1 million. Okay, so that's the 24-month hold. Now, if we do the phase B, I added you the full breakdown, okay, of all the items here, and the loan term. As you know, we're going to have to borrow some money in order to build the first 88 lots. The beauty here is that we're going to borrow $4 million to build. You'll see it here. The $4 million is roughly what we need for the construction of the first 88 lots. And that's a 48% loan to value, which means that knowing that our land will be worth $8.4 million, we're going to ask a $4 million loan to a debt agency, a hard money lender, or a local bank. Okay. And from there, we would have the contract from the buyer saying, hey, I'm okay to buy you the $90,000 times 88 as soon as you're finished building the infrastructure. Okay. So that's the beauty. We don't go into it until we have a strong buyer that puts 10% down, non-refundable, before we start the infrastructure. Okay. In terms of the operating model, you will see how much you would generate as an investor if we decide to do the phase B. So same thing here. If you invest between 100 to 250, you're looking at 115% ROI. If it's 250 to 500, 125, 126, and 146%. Okay, and then below you have your net IRR, which varies between 25 to 31%. So the beauty about investing in land versus traditional commercial deals or multifamily is that not only you can buy the land at a discount because the price is very elastic in the land space, it's not as competitive as other asset class, but you can also force the appreciation of the land if you know what you're doing in terms of entitlement. And as I said, we've done over 2,000 lots in Texas and 100% success rate in subdividing. Texas is very pro-development, and before we close on the land, we have all the studies done to make sure we know how many lots we're going to get 5% with a 5% margin error. Okay, so it could be 260, but it also could be 280 lots we get, depending on how the markets evolve over the next 12 months, what the builders' feedback gives us. And, for all we know, we might do 70 by 120 and get 280 lots. For all we know, we might be doing 65 by 120 in terms of the sizing. Again, 70 by 120 is on the larger side. the bigger side of what builders are actually doing. But we do that on purpose because this is the worst case. If we decide to be more dense and go down to what, for example, Lennar is doing on ground, which is roughly 50 by 120 or 50 by 100, that means we will get more lots, and you maximize your value because you get more front footage of each lot. Okay, so that's the important piece. We're conservative on the exit at $90,000 per lot, and we're conservative in terms of the density that we want to apply for those developers. Okay, so that's the financial model. As an investor, you would probably have a lot of different questions. There's a lot of numbers, but I am available during private meetings to actually dive into that with you, so you fully understand, how much we can get out if we sell on phase A, or how much we can get out if we sell on phase B. That's very important to understand. And the more details we have, the better. You'll see that model is very complete, and not a lot of private equity companies in the land space have as much numbers before you invest. This is the beauty about investing with LandQuire. We give you as much information as possible before you even invest with us. Now, in terms of the data room, you can click directly here. It's going to open all the folders for you to complete your due diligence. In terms of what's important to take a look at, we have our first pre-conceptual. So the first pre-conceptual is the initial drawing that we do with land planners in order to figure where we're going to put the detention pond, how wide will be the roads, what is the highest point of the property, what's the lowest point, how we're going to drain the water, the size of the lots, traffic study analysis, the left lane, turn lane, in terms of access of the property. So lots of different items. This is the version 1, and this version gets improved as we go and acquire the land and finish the entitlement until we get the full set of plans that we can submit to the city. So that's the conceptual plan. Very important document to take a look at. Let me go back. Then second, you have the zoning. So that's very important. You can take a look at the different zoning laws. That's going into the nitty-gritty. But if you are a land investor for a long time, you would probably want to take a look at the zoning laws. So feel free to take a look at that. The contract with the seller. So you will see that we are under contract at $3.4 million, and $1.7 million will be paid at closing. You also have the tax history. Okay, so how much are the taxes for that property? We included in our raise 3 years of property taxes. Okay, so that's very important. The large acreage comps. So that's an important item. So these are some of the pictures of the lots that I gave you with $50,000 price per acre. This is one in Schertz. There's another one. I believe this one is in New Braunfels. So these are cities that are right next to us, to give you an idea of the land selling above $50,000 per acre. Okay. Now, in terms of the land ID, so land ID is really our software that we use in order to analyze a land parcel in terms of the elevation profile, in terms of if there is any flood zone. So we don't have any flood zone on the parcel except at the entrance. But again, that's not going to impact, and it's already taken into account in the pre-conceptual plan to make sure that we still hit the 264 lots. We added you a photo of the Cibolo city limits. You'll see that we're on the south end of Cibolo. This is Cibolo. So everything north of Cibolo is built, and everything south is starting to be built. So our 94 acre is on the other side of the I-35. It's really on the I-10 leading to Seguin. So Seguin is north, and then San Antonio is south. So that's very important. Let me show you the comps that we got from our broker that sold those comps. So I'm not, cool colors. So we have the utilities as well. We have some mapping of the utilities with the water. So you'll see that we have a 6-inch water line. We should have the water study back in 3 weeks, but again, 6-inch should be enough to actually to give us enough water for the 264 lots. The landscape and the Google Earth link. One thing that I'd like to show you, which is pretty important, is like I said, listings of those items that are at 50,000 per acre. So feel free to take a look at Zillow. Okay, so we added the link for you. This is the first one I showed you that sold. This is the second one at 53,000 per acre. That sold at $7 million. So these are typically developable land that are great for a single-family residence subdivision. Okay, and then the last thing is the comps that we receive from the broker. So like I said, this is one finished lot opportunity that is under contract by Greg Jones. So this is the broker that is gonna sell to builder our land, either on a phase A or on a phase B, pre or post construction. So like I said here, if you go down, this is the 1650 per front feet that he's getting. That I put in the presentation. These lots are 40, 45, 50s. Our lots will be a little bit bigger. This is why we're discounting a little bit at 1,300 roughly per front feet. The builder is putting 10% of the contract price before they start the infrastructure. So it's just to give you an example of what's happening in those kind of subdivisions. This one is very close to us and has a very recent contract price. So these are great comps that we get. Okay, so we're on I-10. We're a little bit here, and this is where Chasing Heights here. Okay, so that's one comp out of the 3 that our broker gave us, and feel free to dive in the data room. Okay. So that's pretty much it for that opportunity. We have already a soft commitment of $1 million out of the 3.9 million. So we would have roughly $2.8 million left of new investor capital that would be able to join that opportunity. In terms of the track record, this is our full track record. So you will be able to receive that as well if you request it. We have 22 projects total. Everything in green is sold. Everything in blue is still under entitlement or under contract to be sold here for those 2, the light green. And then everything in pink is under funding. We actually finished portfolio 19 last week, so we're funded on portfolio 19. The total raise for 19 was 2.4 million, and portfolio 22 has just been added and is ready to fund. Our compliance department should be done with the contracts for investors probably by the end of the week. Private placement memorandum and unit subscription agreement. Again, as an investor, we have a very traditional private equity process. You go through KYC, you go through the accreditation to make sure you're an accredited investor. If you don't know if you're an accredited investor, feel free to reach out to my investor relation team so they can help you. And from there, we send you directly by DocuSign the PPM and unit subscription agreement for you to actually buy shares in the entity that will be buying the land. You're free as well to wire directly to the title company if you feel more secure, especially if you have a larger check. And I will be super happy to have conversations with all of you to discuss that latest opportunity. Super excited to present that before the summer starts, before the World Cup starts. Gonna have a lot of different conversations with you. Again, this year we're probably gonna do only 3 to 4 deals. We want to do quality over quantity, and we want to make sure that all the entitlement processes are on track, on budget, to make sure we maximize the disposition. That's all for me. Thank you so much for listening. I will take questions now. Go back let me go back here to see if there's any questions. Stop my recording. Okay, great. I see Priya. Oh, let me see if there's questions above. Okay, hi Paul, hi Collins, hi Arminia, Fabienne, how are you? Pierre-Lou, how are you? So the first question is from Priya. Hello, how did LandQuire select Cibolo specifically instead of another area near San Antonio? Again, it's a mix of different factors. We've been investing in San Antonio for the last 3 years, and the surrounding areas of San Antonio. We like San Antonio because the price per acre is much cheaper than Houston, Dallas, and Austin. It's still the 7th biggest city in the US within the state that has the largest demographic growth, GDP growth, infrastructure growth. So in terms of the state, we're pretty sure that Texas is really where we want to put our money for now. Now, Cibolo is really positioned on the high growth corridor that is the northeast of San Antonio, leading to Austin, leading to New Braunfels, leading to Seguin. This is really the triangle here between Seguin, New Braunfels, and San Antonio, where there's the highest growth in San Antonio. So that's I guess the first thing in terms of doing single family residence. If it was mobile home parks, if it was other asset class, we could do other areas in San Antonio. But in terms of single family residence, this is where you have the highest growth, where the builders are really looking to build houses. So that's, I think, in terms of the market. Now, there's also the opportunity when you're able to get a parcel that you can subdivide for 265 lot at $36,000 per acre, and it fits all the criteria on the land side, the access, the topography, the traffic study, the density, the pre-application meeting with the city and the county. These are different land criteria that we're looking at. Not every land deal works. If you look at our PUD, our portfolio 18 was supposed to close and didn't close. Our portfolio 16 was supposed to close, but the due diligence didn't work. So you have to make sure that once you find your market, your due diligence works. And this is what LandQuire does. We always invest our money first, probably between $100,000 to $150,000 per deal, in order to make sure that once we present in front of investors, this is where we want our investors to place capital. Okay, so lots of different criteria in terms of the market and the land. What happened if the project exit after phase A instead of continuing into phase B? Well, you will see in the financial model that if we exit in phase A, we just sell roughly at $32,000 per lot, worst case scenario. So you take the $90,000 minus the construction, minus roughly 20% discount, and that gives you the pay per lot value. How much the lots are valued pre-construction, but post-entitlement. It's called shovel ready. From there, we don't do the construction. We just sell the whole project, very similar to what we are doing for portfolio 13 on the east side of San Antonio. On the east side of San Antonio, we're in the contract with the largest builder in the United States. I'm happy to share his name on a private call, but we're working with the largest developers in the US on that deal, but that deal is bigger. It's 1,000 lots. Here it's 264 lots, so it's roughly 25% of the size of the previous deal, and that's also interesting because once you get smaller deal, you also have more buyers. The higher you go in terms of the amount of lots, the less buyers you would have. So at 264 lots, what I know is that we're going to have much more buyers because you can have all those regional buyers, regional builders that are able to build 88 lots per year. That's really the most important. And you could have a larger builder that tells you, no, I'm going to buy the whole thing from you. I don't want to wait. I'm going to buy everything. So if they do that, then that's even better, because we shorten the amount of time that we would held that parcel, and the exit would be more in 36 months rather than 48. So those are metrics depending on the buyer coming to the table and how much they're willing to offer, and how they structure the contract price. Okay, but based on what I'm seeing right now is that typically for that size of subdivision, we're looking at anywhere between 2 to 3 phases. Okay, so that's very important. Is the 10% preferred return paid annually during the project or accumulated and paid at exit? This is a great question, Priya. We are paying at exit, and the reason why we're paying at exit or once we sell the first phase is because there's no cash flow. You're not in the traditional multifamily where there's cash flow in place. You can calculate your cash on cash return. It's very different here. Here, this is a land flip model where we buy the asset at a discount on the price per acre. We force the appreciation. We either sell on a shovel ready or we build infrastructure for a builder. So the preferred return can only be paid once we get proceeds from selling those lots. Okay. If we would have to pay annually, then you would have to raise that preferred return from the investors, which doesn't make sense. Financially, it just doesn't make sense. It's better to make sure everyone gets paid once we get proceeds from selling the land, a portion of the land or the entire amount. So those are a great question, Priya. Great questions. Is there any other questions in terms of taxations, in terms of contract with the seller, in terms of the market in Texas? If you have any other questions, just let me know. If not, I'm happy to answer your questions via emails or on a private consultation with one of my investor relation director. We do have 5 investor relation director. They speak French, Spanish, Portuguese, and English, depending on your preferred language. And we do have a CPA in the US, obviously, that would oversee the K1. So we're happy to put you in touch with our CPA. We're happy to put you in touch with our broker that will sell the deal on ground. He's a specialist broker working with builders for the last 20 years. So that's his expertise to sell those kind of subdivisions. We're happy to put you in touch with our land planner as well. Our land planner is basically the person on ground that grinded out in terms of the permits and in terms of the plans to make sure that we're pushing things forward. I'm happy to put you in touch as well with our head of entitlement, Willem van Biesen. He has been working full-time with us for the last 5 years. He's a key principal in the company. And my partner as well, Cibolo, that oversees customer service and investor relation, that will be the one, answering the phone calls when you have questions during the process, pre or post acquisition of the land. We're trying to make sure the communication goes great after you invest, and making sure that we can do the full cycle. We've done the full cycle on 6 deals. We're looking at 22 deals total acquired. So 22 minus 6 are the deals that are left to be sold at the moment. We've been doing that for 5 years full time, and we're looking at doing it for the next 5 years to help investors invest in land. Again, thank you so much for your time today. It's been 52 minutes. I speak fast, so a lot of information. Sorry if I was a little bit too fast. We will send you the replay of the webinar if you are interested. You can request after you do your KYC the brochure that I showed on the screen and the data room. I'm sure, Paul, you can send it via email. Paul is our head of marketing. So Paul, if you can confirm to me that you can send to everyone present on the webinar the brochure and the financial model, that would be awesome. In terms of contracts, if you have questions, we have our head of compliance as well, Sebastian, that can answer all the questions, whether you invest on a 506C as an accredited investor or as a Reg S if you're an offshore investor, if you're not located in the US. We have two different set of contracts. Those are, the same contract is just a different regulation. And we can get into the details with you on a private call. Thank you so much, and talk soon. Thank you all. Bye-bye.